Michael Burry, come on. Burry barely, I was looking up his fund. His 13F doesn't have any money in it. We generally ban anyone who asks about Burry in here. Name a more interesting investor? Let's see. Let's go to the hedge fund list. Literally anybody else. Anybody who works at Citadel, Jane Street, or Millennium, or D. Shar Renaissance, or Susquehanna, or AQR. Anyone at 2 Sigma or Valley, 0.72, Viking, Co2. We also ban people who say Nancy Pelosi. Literally anybody at these firms, not even the bosses, like anybody else. You only know about Burry because there's someone made a movie about him. That's not real Wall Street. That's like thinking Santa Claus is the best logistics provider. That's like thinking the Easter Bunny is the largest producer of poultry.
So you kind of just have to know your territory a little bit. And that's why I always recommend stick to one sector. You want to study utilities? Study utilities. You want to study biopharma? Study biopharma. You want to study tech? Narrow that down. Tech is a lot of stuff. Narrow that down. Software? Even that you can narrow down. Enterprise software. There's a lot of things that you can call software. And once you narrow it down to a space that you think you can handle, you'll become an expert. There's no better way to become an expert in some sector than following every company in that sector. You read all the press releases, you read all the SEC filings, you'll become an expert whether you like it or not. Listen to all the conference calls, read industry websites, and then people will want your expertise. They'll pay for it if you want to sell it. Or you can use it yourself, or both. A lot of people started off selling newsletters or being a journalist in that space that they were supposed to know really well. And then they decided that they would become an investor. This happens sometimes in VCs.
Yeah, investing is about looking at the fundamentals, weighing it against the price you're paying. That's it. I mean, why people don't understand this, I really don't get. Here's an example. Here's a $100 bill, okay? And it just came off the mint. Have you ever had one of those dollars? It's like so crisp and clean. It's like amazing. It's like never been folded. It's never been used. It looks like looks amazing. Would you buy this for $300? Some of you, it sounds like you would. It really does. And now here's a $100 bill. It's got the face, Ben Franklin's face, and it's old and crinkly. Got even a little bit of tear over here somewhere, a little torn. Yeah, would you buy this for 50 bucks? When you tell me that Chegg has a problem with AI, you're basically telling me, oh, that $100 bill has some dog poo on it. Yeah, I know. Everybody knows that. The question is, what price are we paying for it? That's what matters. You give me a $100 bill for 50 bucks, I'll take that. I don't care how much dog poo is on that $100 bill. I'm gonna go cash it in. Maybe I could clean it up. The bank will take it either way. That's all I care about. So that's the rough analogy. I'm not gonna pay $300 just because it looks shiny and bright and new. Why? Nah, I don't do that. This is called value investing. But PEG ratio is like a weird way to normalize growth in PE. It's not really useful, but it's getting at the right idea. Like, it's a good stepping stone for investors trying to think about, like, okay, how do I incorporate growth into my thinking about earnings? And you eventually take this journey to DCF land and NPV land, where you'll really think about it. And then there's more journeys to take. Like the beginning investor, no, if you're a noob investor and you want to put like $5,000 in Godel, I'm going to pass on that, but I appreciate it. Anyway, when we start investing, we sort of don't even look at earnings at all. We just look at stock price, memes. What else do we look like? Consensus or sentiment, social media. This is like phase one for all investors. Like some people even look at the stock ticker and they're like, wow, I like that stock ticker, or I like the name of the company. I'm going to invest. It sounds like a cool company. I don't even think about, financial statements. And then we kind of look at financial statements, but we don't really do any computations. We just kind of hear about, okay, the company has earnings, or, the company is growing or something like that. We just sort of like vague understanding. And then finally, we start to think about PE, which is sort of these like kind of dumb ratios, price to earnings or price to sales. Like, okay, there's a such thing as these things, and we start to think about them. We don't think about them too intelligently. And then at some point we just use them on a level one thinking basis. And then we kind of start to think a little bit more intelligently about them.
almost to the point of a professional. Now, what's funny about this is in the pyramid of stock thinking, like this is honestly where a lot of Wall Street still is. Like a whole bunch of people in Wall Street stop right here. Now the PEG ratio is as if it was like a really small step in this journey. Like it's a really quick step from PEG to like, you can even say like normalized PE is probably even better than PEG ratio to like just DCF land. And the problem with DCF NPV land is it's not perfect either. And as you go down this, kind of get to like reverse DCF, which I think is a really good place to be in valuation and thinking about stocks. You know, I think this is a reasonable place to be. But there's more steps, and a lot of people sort of think about this and they overthink it. And this maybe is like not necessarily next, but it could be like parallel, is they just think about inputs and sensitivity. You don't have to calculate DCFs. You just know what the inputs are and how sensitive the market is to them. And that's sort of one way to look at it. What could come next after this? I'm not sure. Probably the hardest part here is thinking about things as a management or project IRR basis. This is something almost nobody does, except for your boy. And this is like probably the, I don't know about secret sauce, but like, because some investors are really good with just technical analysis. Like you can be a great investor just doing this. Because the biggest problem with DCFs is that they don't really understand management. Companies are not static, they're living, breathing things. And to understand that, you have to understand that management is always seeking to provide returns, depending on the management you're dealing with. So this is your roadmap on at least philosophical thinking for investing. You have to make it through 7 stages to get to nirvana. Oh, wow, these guys are super levered up. You guys see that? You know what that's like? That's like when you see the chick looking fine, right? Hot as hell. And then she turns around, this is the side profile, and she got that badonkadonk. That's the side profile. Just carrying all that leverage right there. That's leverage. Leveraged finance, LevFin. I'm in the LevFin department myself. Just BBLing it right now. I'm sculpting it a bit. A little bust there too. This is the beautiful art. It's a female form, okay? I'm like Michelangelo right now. That's what CenturyLink is. All right, 6 billion market cap. And then you turn around, look at the debt, 23 billion. It's a lot of debt. This thing is thick. And so like, what's the relationship between market cap and debt? And market cap and EV? Like, could they go from 23 billion EV to 6 billion market cap? Like you meet this really thick girl, you know? Leverage right there. Massive leverage. All right, so 6 billion market cap, 18 in debt, which makes 23 billion enterprise value. Sometimes leverage overwhelms us. I just picked a color, don't read into it. Well, it's a telecom company, a lot of them are levered, but this is like 3-to-1 leverage more. Oh man, revenue's declining too. See, this is why it's useful to have debt in your terminal, because you see, look at the debt and say, do I want to play the debt? Enterprise value. So this is a basic concept in finance. If you're not familiar with it, you have to become familiar with it ASAP. So, you know, the market cap is pretty simple, right? This is how many slices of pie are there. In this pizza pie, there's 8 slices. If it's $1 a slice, the whole pizza is $8. That's the market cap of the company. You might buy a share for $1, but there's 8 total shares. So if you buy 1 share, you own 1/8 of the company. Now, the problem with companies is there's a lot of shares. So in this case, there's 49 million shares. You can imagine there. Each share is like a really small cut of the pizza. And it's $46 a share. There's 49 million shares. We did the math earlier. That's $2.2 billion market cap. So by buying 1 share at $46, you don't own very much of the company. Now there's cash and debt. So when you have a $2.5 billion or 2.25 billion market cap, and here's the company. You're buying a share of the company. It's in this box. What's in the box?
Well, it's all the assets of the company, right? But it's also all the liabilities. Well, we're trying to value what's in the box. You know, the box spits out earnings every year. I don't know if it spits out maybe 100 million in earnings every year. So do you want to buy this box for all the earnings it spits out? So that's basically the main idea. But there's also something else in the box. There's cash. In this case, there's 230 million in cash, right? So basically, the part that's the cash, you can almost like separate out. And you can basically say the box without the cash, if you own the company, you could do this. The box without the cash is worth 2.0 billion because that 230 in cash is worth 230. So if I subtract these two, I'm left with 2.0. So you're really buying the company for 2.0 billion. Now the problem is there's also debt. In fact, there's more debt than cash. There's 587 million in debt. So you actually have negative 350 in cash. So the enterprise value, if you paid off all the debts, you're paying 2.6 billion for the company. And the company is whatever earnings are going to come out every year, which can change every year. The enterprise value of the company is 2.6 billion when taking into account how much cash and debt exist. That's an explanation of enterprise value. The cash is not needed to generate earnings now. There's some working capital needed, but that's another story in general. Some small amount of cash is obviously needed to run the business and working capital and whatnot, but the point is the enterprise value calculation normalizes the company for all the cash and debt it has. Yeah, level 3 ADR is basically a unsponsored ADR, and every single company has one. They don't really trade. You want to do the main listing, right? So if I type evolution in here, the main listing is this, which is EVO. SFB, which stands for like Swedish Financial Bourse or something, right? And if I just click stocks, you know, there's other evolutions, but I just click evolution AB. This is a pink sheet ADR. It trades on the pink sheet. So what's important is you have to ask yourself, what exchange does this trade on? And in this case, you have 5 different, exchanges that Evolution trades on, but only one of them is the main market, which is EVO in Sweden. It's a Swedish company. Could there be liquidity in some of these other ones? Not likely, but it's possible. So this ADR was made up by somebody that is not Evolution AB. Otherwise, it would trade on NASDAQ or NYSE. If they wanted to make an ADR, they could, but they did not. So Nestle, Roche, those are 2 examples of some very big companies that only trade in their local markets. Let me give you an example. If I wanted to look up Roche ADR, it's RHHBY. Do you see that? RHHBY, and it's $39. Okay, so here's what we're going to do. It's going to be really interesting. We're going to do, what is the dollar value traded? Another one is Nintendo. Nintendo ADR, $13. But how much volume does it trade? I'd like to look at it on Yahoo Finance. There we go. So 1322, what's the volume? 26,000 shares, okay? Nintendo has nothing to do with this ADR. Now, it's not illegal or fraud, but somebody else set this up. So here's the price, 1322. How many shares traded? 26,389. Now, you might say that's enough for me, and that's fine. There's a lot of issues trading on the US pink sheets, by the way. A lot of people aren't allowed to do it professionally. The exchanges are very murky and not great. So the real Nintendo trades in Tokyo, of course. And let's multiply the volume by the price. This is the dollars traded amount, right? So this is the amount of actual dollars that traded for Nintendo today. And I could look at yesterday's volume or whatever, but it's $350,000. Got it? So now let's look at the real ticker, which is 7974 in Tokyo Stock Exchange, the real deal. And the price is 8,000 yen, 8010. And the volume last night was 2.3 million. So
let's look at the yen exchange rate. So we're just going to keep this in dollars. It's 151. So multiply this times this divided by 151, and you can see that $124 million of Nintendo traded in Tokyo. But only $300,000 traded on that shitbird pink sheet. It's probably even worse for evolution. Let's look at evolution. Here's their weird pink sheet thing, 𝐉𝐵TY. I bet you there was almost no trading, 5,000 shares. So that's 𝐉𝐵TY, US pink sheets, 8966, volume 5889, amount traded, $500,000. Again, you might say, look, I don't take that big positions. That's fine. Only buying and selling $1,000, you know, who cares? Not all of us are like that though. And we might want to see evolution AB in the main market. Here's the Swedish market. And so this is 946. This is Evo. And this is Stockholm stock market. Got that right? And look at how much traded, 406,000. 106,846, and we know the Swedish krone is what, SKE to USD, SEK. And that's 1054. So this times this divided by 1054, and again we can see 36 million traded versus just 500,000 for the pink sheet ADR. Yeah, you get exposed to FX if you buy a Swedish stock because you have to pay in Swedish krona. So hopefully you'll understand that all of the liquidity is in these local things. Now, why would somebody set up these sort of fake securities? Well, on the pink sheets, the market makers actually cross all the stock. So it's not as electronic as post your bid, post your ask, and shares change and clear immediately. There's actual old school market makers in the pink sheets, and they actually make a bunch of profit on the spread. So it's a bit of a exchange, and so they just make that just to make a little extra money, and it's not a really viable place to trade for a professional. So I would get used to trading with the big boys and girls on the real exchanges. They will rip you off for 5% if they can. Forecasting requires a pretty solid knowledge of the industry and the company and so forth. Forecasting can be very scary because it's very easy to do, but it's very hard to get right. It's kind of like painting. Anybody can take a paintbrush and go pretend they're an artist, but is it actually going to be a good painting? After you've painted 1,000 paintings, you might be better than if you've painted 2 or 3. Forecasting is nothing to do with DCF and WACC, in my opinion. Forecasting is about the inputs that go into those formulas. Those are more equations to me than they are forecasting methods. I don't know if that makes sense. So you have to think about the inputs like cash flow or net income, and then risk like cost of capital or discount rate or whatever. I thought the Tesla event was fine. I think it's a buy on this.
So every time I improve my process by even 5%, that means I can look at one more stock from 20 to 21 every day. That 21st stock might be the big winner. A lot of people, every rookie I meet in investing, they say the same thing. Oh, I love stock X, stock Y. Maybe it's Cassava today, maybe it's some other stock tomorrow. GameStop, AMC. When the whole GameStop, AMC thing came around, people were saying, Shkreli, you're out of prison. Great. What do you think about AMC? And I'd say, okay, let me look at it. I'd say, why do you like this thing? What's the story? And they tell me the story, and I said, let me ask you something. Forget about AMC for a second. How much of your money do you have in AMC? And they'd say something like, oh, I'm all in. I said, okay. Let me ask you something else. How many stocks have you looked at to determine that AMC is the best stock? And they say, I looked at a couple of stocks. I'd say, how many have you really looked at? Because you know a lot about AMC, but do you know a lot about Intel? Do you know a lot about NVIDIA? Do you know a lot about Microsoft? Do you know a lot about any other stock? Even AMC's own competitors.
You're like, no, I'm just focused on this one. Why? You can find a better stock that's going to go up. In fact, AMC, when I said that, went down 95%. 95%. Virtually any other stock would have beaten AMC. Forget finding something like an NVIDIA or something like that. But any other stock would have beaten AMC. Even GameStop. But you're in GameStop and it's underperforming, well, maybe you could have bought in Datadog. Maybe you could have bought Kava. Maybe you could have bought anything. But you gotta look, you gotta turn over those rocks. Hundreds, thousands of rocks. And then you'll find the one that is the best of the best. You know what you should do? Almost make it like, I mean, this is stupid. This is like me as a little kid. I used to watch a lot of sports. Wasn't a whole lot to do in Brooklyn. So I was obsessed with sports. I had a big baseball card collection. One of my favorite things was the Final Four, the Sweet 16, the NCAA basketball tournament, March Madness. Make yourself a little bracket, but instead of sports teams, this is really stupid, but this is better than what most people are doing. You just put in each stock, Cadence Design Systems versus, Cassava. Okay, we know which one's going to go to the next round. If you do this, you'll get some decent portfolio, to be honest. But don't stop and say, okay, let's look at a couple more. Which ones have we been looking at? TARS. Okay. My worst stock ADMA. Here's ExxonMobil, whatever. So let's say you keep going down this list. Remember, there's 64 of these. And you say, you know what, this ADMA looks great. I really like it. I want to buy it. Well, okay, you can do that. But does it look better than this one too? And then does it look better than this one? How far does it make it? Does it make it to the Final Four? And here's the thing. Every investor has their weaknesses. Remember what I said last week? You should sell ADMA whether or not, you make money by Thursday? That's good trading advice. Did I follow that good trading advice? No, I didn't. And there's poker players, they'll tell you, like, even though you should do this in a poker hand, sometimes they say, you know what, I'm going to do that. And those mistakes can cost me or that poker player a lot of money. Or they can just work out that one time by accident, by luck. But you don't have to make those mistakes. You don't necessarily have to make the same mistake. So some of the best coaches, think about it this way. Magnus Carlsen had a chess coach, right? I met this guy, Bruce Pandolfini, super nice guy. One of the best chess coaches of all time. He's immortalized in a film called Searching for Bobby Fischer. And he's coached many of the greatest chess players. But his peak rating was 2,200. Not that high. I beat 2,200 tournament players before. Good old Brooklyn guy. He stopped playing professional chess 50 years ago. But he taught some of the best chess players ever, including Josh Waitzkin. And his ability to teach was better than his ability to play. And he's written a lot of books. Jesus, more books than I remember. And he's one of the best coaches ever. Now, I also had a different chess coach, a guy named Yaroslav, who's one of the best in the world. He also tried playing amateur poker. Did fairly well there. And Yaroslav is like top 50, top 100 chess player in the world. I like Yaroslav a lot. He's not as good of a coach as Bruce. Bruce is very good at coaching and also good at playing. He's great at coaching, good at playing. Yaroslav is amazing at playing and okay at coaching. He's not a bad coach, but he's not like Bruce. And Yaroslav's very young. Bruce retired 20 years before Yaroslav was born. So, you just have to sort of listen to what people say, but not blindly. Listen and integrate it into your own stuff. There are some things where you kind of should listen blindly, but when that happens, I'll sort of tell you, everything else, and even then you might not choose to use it or whatever. But, try to be intelligent about what you learn from me, and then try to be intelligent about what you learn from reading about Warren Buffett and watching his annual meetings, reading all the stuff you can about him. Maybe you have somebody IRL that you talk stocks with, learn something from them, including their mistakes. So there's a lot of ways to win in this crazy stock market world. And I'm happy to play a really, really small part in that.